The yield on many government bonds has turned negative, and that's led some people to suggest that we're in a bond bubble. Prices are just simply too high because they've been overinflated by central banks, pumping money into the economy. If they're too high, then perhaps they're about to crash. So to see how big a crash in the bond market could be, and where we should expect rates to be in the long term, let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Many people have pointed out that there are an increasing number of countries with negative bond yields. And specifically here we're talking about government bonds. So in this spreadsheet from Charlie Bilello, you can see the negative bond yields in pink. And over time, the amount of debt which has a negative yield is increasing. So in June 2019, it reached $12.5 trillion. And as the amount of negative yielding debt increases, some people have started to suggest that this is a bond bubble, which has been inflated by the central banks. Now let's step back a little bit and see why we buy bonds. In the case of government bonds, which in developed markets are very safe, the primary role in a portfolio is capital protection. To see what we mean by that, let's compare the return on the S&P 500 with the return we'd have got from 10-year treasuries. And this is since 1950. Notice how for equity, there are lots of lumps and bumps on the graph. And that's because equity is very volatile. You tend to get very large falls and very large rises in the value of equity. If we compare that with bonds, you see a much smoother line. There are still up and down movements relative to the trend, but these tend to be much smaller. But as an investor, you may want to think about how much the index has fallen relative to the highest peak it's reached. So if the index is at an all-time peak, then it stays at zero. But if we fall relative to that peak, we start to see a drawdown. Now what really stands out for equity is that those falls relative to the peak are very severe. For US stocks, there are several times when it's been more than 40% in the 1970s, in the early 2000s, and during the global financial crisis. If we compare that with bonds, you can see the crashes are much smaller relative to the previous peak. It's very unusual for it to be more than 10%. So while bond bubbles for US Treasuries have popped in the past, the size and duration of those bond bubbles bursting is considerably smaller than it is for US equities. So there's a lot less to fear about a popping of a government bond bubble than there is for an equity bubble. If we look at that in a slightly different way, and here I've plotted the monthly return on the x-axis, so positive returns are here on the right, and negative returns are here on the left, you can see that this downside tail for equity is much bigger than it is for bonds. It's very unusual for bonds to stray above around 5%, whereas for equity there have been several cases where monthly returns have been less than -5%. So bonds preserve this cardinal rule of investment, which is not to lose money, or at least not too much and not for too long. Another reason for holding government bonds is diversification. Here are some Vanguard funds, and the size of the dots on this diagram show you the size of the correlation between two funds. So for example, European equity, VEUR, is highly correlated with the UK FTSE 250 index, which is called VMID, whereas the correlation between European treasuries, VETY, and the FTSE 250 is very low. This block of very large dots shows how equity funds are highly correlated with one another. It's almost impossible to diversify the equity in your portfolio by buying another equity fund, no matter where that equity fund is based or its investment style. And to a lesser extent, bond funds are also correlated with one another. The place you get diversification is if you combine stocks and bonds, because there you really can reduce the overall volatility or risk of your portfolio by combining stock funds and bond funds. For example, if we just consider two funds, a FTSE 100 fund and a UK government bond fund, and we've got risk at the bottom of the plot, so high risk is on the right and low risk is on the left, and we've got return along the y-axis. So this is low return, and at the top we have high returns. You can see that the stocks are high risk and high return in this period between December 2016 and June 2019. whereas UK government bonds are low risk and low return. They have about half the volatility of UK equity. But if we combine them in this magic ratio of 75% bonds and 25% shares, our combined portfolio has a risk which is smaller than either government bonds or UK equity. And although its return is considerably less than for stocks, that minimum risk portfolio has a return which is considerably better than that of UK government bonds alone. And that's what we mean by diversification. We combine assets and their combined risk is considerably less than the risk of any of the ingredients. If we see that as prices, the stocks are in red and the bonds are in blue, and if we mix them in that ratio, the combined portfolio is shown in green. Notice how the fluctuations in the value of the combined portfolio are considerably smaller than either those of bonds or of equity. And that's due to the benefits of diversification. Another reason for choosing government bonds is to generate income for your portfolio. Many people ask me, if the yield is negative, does that mean the income from your bonds or your bond funds will be negative? Here's an iShares fund which buys UK gilts, those are UK government bonds. Now it will never be the case that the distributions or the dividends of the fund would be negative. Here you can see the funds paying out twice a year, as it has been since November 2015, and the payments are always positive, and that will always be the case. The dividends on a fund will always be either zero or positive. They will never be negative. You can always look up a bond on the UK Debt Management Office website. The government raises money through these gilt auctions, and you can find out how much money was raised and what the coupon was on the latest bonds. So on the 2nd of July, the government sold this bond, which matures in 2025, and the coupon on the bond was 0.58%, and the amount the government raised was £3.4 billion. The price of a government bond starts off life at £100 and it ends its life at £100, because all you're doing is lending that money to the government and then receiving your £100 back. And in the interim, you'll receive some interest payments, and that's the coupon. So this bond, which was issued in 2013, paid a coupon of 1.75%. And notice how the price started out at around 100, it rose a bit, and then it fell back to 100 just before it matured in 2019. So if we invest £100 in the bond, we'd be paid twice a year, which is the convention for UK government bonds, and each payment would be half of that 1.75%, which is 87.5 pence. And the last coupon payment would be on 22nd of July 2019. Now that coupon will never be negative. It can be zero, as we'll see, but it'll never, ever be negative. So here's an example of a bond which will give you a 0% coupon. In other words, no interest payments at all. It's a 10-year bond which was issued on the 10th of July 2019 and which will mature in 2029. But as you can see, the coupon is 0%. But note that even though the yield is negative, the coupon isn't negative, it's zero. Now we can take the total return on a bond and break it down into two components. One is capital gain, in other words you buy at a low price and then sell before maturity at a higher price, and the other component is income. Those are the coupon payments that we saw. Now what we can do for this fund, which is a UK Gilts All Stock Index Fund, which purchases UK government bonds, is to compare this accumulation version of the fund, where the price incorporates those coupon payments, with this other version of the same fund, which pays you the income, and where the price doesn't reflect that income. And by subtracting one from the other, we can see the income from the fund and separate it out from the capital gain. And here are those two components. The capital gain is in red and the coupon income is in green. Notice how that coupon income is like a steady, safe heartbeat. It effectively is riskless because it's paid to you by the UK government, which has never defaulted on its debt. It's never failed to pay a coupon or to repay its bondholders. But compare that with the capital gain, which is extremely volatile, very risky, because this is a response to the change in the yield curve, which is flopping around all the time. If we put those two components onto a risk-return plot, you can see that the capital gain has been very high, but it's also been very risky, whereas the coupon income for UK gilts is extremely safe, almost riskless. But of course it's much smaller than the capital gain that we've seen as yields fell. So this is a useful way to think about the two components of total return for a government bond. The capital gain component is high risk, and usually that's not why you buy a government bond. The income, on the other hand, is very safe and low risk, and that's the reason why many people buy government bonds, for that safe, steady income. So we've seen the income can't be negative. The coupon is always either zero or positive. But can the capital gain be negative? This is where the yield curve comes in. The yield curve is a plot of how much it costs the government to borrow over different periods of time, ranging from 1 month up to 30 years. And what usually happens is if the government borrows for a longer period of time, it costs them more in terms of interest payments. Or from your point of view, you get a higher level of interest rates for longer dated bonds. But what's critically important is that the yield curve isn't a static thing. In dark green you can see the latest curve, but that's quite different from the yield curve 1 week ago in orange or 1 month ago in lighter green. And as that yield curve moves around, the price of your bond will fluctuate. And every country has a different yield curve. This is the US yield curve, and you can see that the 10-year rate is 2.1% versus just 0.8% for the UK. And Japan has notoriously had negative rates for a long period of time. Their 10-year yield is negative at minus 0.1%. And in Europe, the 10-year yield was minus 0.38% when I made this graph in July 2019. So let's focus on that Eurozone yield curve and that minus 0.38% yield. What does that mean in terms of individual German bonds? Here's a 10-year bond that matures in 2029. At the time it was issued, in January 2019, a fair coupon was considered to be 0.25%. And that will be fixed for the entire lifetime of the bond. And as we saw for the gilt, the value of the bond on the day that it was issued was €100. But what happened was that its price steadily increased until it reached 106.3 on July the 5th. The value of the bond when it was issued was €100, and on July the 5th it was worth €106. But remember, at maturity, the bond will always go back to a value of €100. Because the bond will exist for 10 years, that means we're going to lose out on €6 spread over 10 years, which is a capital loss of 0.6%. And that means that the total return on the bond will be the income, which is 0.25%, minus the capital loss, which is 0.6%. And that'll give us a total return of minus 0.35%. So as the price of the bond went up, the yield on the bond went down until it reached minus 0.37% in July. It's not because the income was negative, it's because the capital gain was negative. And that dragged the total return into negative territory. Now, the natural fear when yields are negative is what happens if yields suddenly start to increase, because that could make the price of bonds fall sharply. But could we still get a positive return even if yields are increasing? As it turns out, yes, we could. In order for that to happen, to have a positive total return, the income would have to exceed the capital loss in any period of time. Now, the income is just the percentage coupon, and that's fixed. And that has to be greater than the capital loss, which for a bond is its duration, which is the average time that the cash flows occur in future, multiplied by the shift in the yield curve. And this is why we say the longer the duration of a bond, the greater its risk. So a 30-year bond is much riskier than a 10-year bond. If we divide through by duration on both sides of that inequality, we come up with this very simple result. You can think of this as a speed limit. If the yield changes slower than that speed limit over the course of a year, then even though yields are increasing, we could still make a positive total return. The speed limit is defined by the coupon of the bond divided by its duration. So in the case of that German Bund, the coupon was 0.25%, the duration was 9.5 years, which means that the speed limit is 0.03% per year. If the yield curve increases by more than 0.03% per year, we'll make a loss on the bond. For that bond which had no coupon at all, the speed limit is 0, so any increase in the yield will decrease the value of the bond. Can we apply this speed limit idea to bond funds? Yes, we can. Let's look at that iShares Gilt Fund, IGLT, as an example. The yield of the fund is 1.2% as of 4th of July 2019, and the effective duration was about 11.6 years, and that means the speed limit is 0.1% per year. If the UK yield curve increases at more than 0.1% per year, we'd make a negative total return on this fund. This is the value of a hypothetical £10,000 invested in that fund since December 2006. And over that period, you can see the total return has been positive. But of course, over that period of time, yields have been falling in the UK. So both the income and the capital gain have been positive. Now, a key question is how much rates are going to rise. They're at an all-time low at the moment, but if rates don't rise much from where we are now, then that could limit our capital loss. Here's the UK 10-year rate since 1993, and you can see it's been falling fairly steadily over that entire period of time. And that's been great for bondholders because they made capital gains during that period. Fortunately, the Bank of England keeps very long-term records, and you can see that their bank rate has been falling fairly steadily since the early 1980s. In fact, their records go all the way back to 1694, and the average rate has been somewhere around 5% over that huge period of time. There was a huge spike in the 1970s when inflation reached very high levels, and then after the financial crisis there's been another very unusual period, but in this case it's because rates were very low indeed, as has been the case for many central banks around the world. The Bank of England uses the term equilibrium interest rate, also known as R star. Think of this as a kind of anchor rate to which policy returns if everything is okay. And by okay, we mean a position with no output gap, where our economic output is equal to our potential output and inflation is at the 2% target rate. And if the Bank of England sets the bank rate equal to that R star value, it'll just keep the economic machine ticking along. Now, if we look at the Bank of England inflation report from August 2018, they do a fascinating analysis, which shows that the bank rate is likely to remain materially below that 5% level that we saw since 1694. And it's not just a small fall, it's by more than 2 percentage points since 1990. If we add back inflation at 2%, that means that neutral rate, or R star, will be around 2% to 3%, considerably lower than 5%. You can see that the equilibrium real rate was falling before the financial crisis. It fell significantly during the crisis and now has come back to a level which is far lower than it was in the past. What are the economic drivers of that fall? Well, the biggies are slower population growth, increased life expectancy, and very slow productivity growth here in the UK. None of which is likely to change much in the near future, so that lower R star value is likely to be here for some period of time, because our population continues to age, and our productivity growth in advanced economies, but also here in the UK, remains stubbornly low. And the upshot for bond investors is that the end point as the Bank of England raises rates will be much lower than it was in the past, which means that those capital losses will be smaller than you might expect if the equilibrium rate was still at 5%. And that'll limit the size of the pop if the bond bubble bursts. So the capital gain on bonds has been boosted by that steady fall in yields that we've seen for several decades now, but that's about to end. However, it looks as if we're not going to see a huge spike in rates from where we are now, given beliefs about R star, or the equilibrium rate, which is now going to be lower than it was in the past. So I'm not particularly worried about a bond bubble, and I certainly wouldn't buy into the idea that you should have no bonds in your portfolio because the bubble's about to burst. For most people, that's just simply not true. Now, if you found that video useful, then please subscribe to our channel and support us on Patreon. We rely completely on you for support. We don't take any money from fund managers or from funds, and that's so that we can remain independent. We can say what we think, and we think that's best for you. But we can only do that if you support us. So for $5 a month, you get to join us on our weekly Q&A call. You can ask anything you want. You can join us on Slack and ask questions of me or the community. And it's a very friendly family feel. We travel the investment journey together in a friendly and supportive environment. And if you pay $15 a month, then you get a one-to-one with me every other month. And if you do subscribe, we'd love to see you on those Sunday evening calls. And as always, thank you for listening.